Welcome, 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 and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, March 29th. Now, right off the bat, I must clarify that I am not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line during market hours, and from this podcast. Just recently, in fact this week itself, I wrote to my paid subscribers about a new AI stock that I opened a position in and I plan to go overweight in. What's interesting about this stock is that NVIDIA, the GPU darling of today, NVIDIA actually depends upon this company to produce their GPU chips. And therefore, I was very interested in this company and this stock and decided to open a position in it. And by the way, I wanted to give you a heads up that my best sale of the year that comes only once a year on Mother's Day or during the Mother's Day week, that sale is coming up soon. This is my best subscription discounted deal on the annual subscription rate. So look for that in your inbox. Look for details about that sale in your inbox soon. And I also wanted to thank you for giving me a chance to go on a little break, on a little vacation. I am back at my desk. I thank you for your patience. I believe that it's important to take some time off. When I was in the corporate world, my vacation policy was that I did not bother other people that were on vacation. And when I was on vacation, I did not want to be bothered as well. So I appreciate your patience. I'm back at my desk and let's get on with the markets. So markets are closed today for Good Friday. Yesterday, Thursday, the S&P 500 closed its best ever Q1 in over 5 years. The index rose over 10% for the quarter. The Dow Jones rose 5.6% in Q1. This was its strongest Q1 since 2021. And the Nasdaq added over 9% in Q1 this year. This was the 5th straight winning month for all these 3 indexes. In fact, on Thursday itself, the S&P 500 and the Dow Jones notched up another all-time new highs for each of those indexes. The Nasdaq lagged a little bit on Thursday. Energy stocks were the clear winner for the month of March. They rose or they added 10% in the month. This was followed by material stocks that added 6%, and even utility stocks added 6%. The laggard sector, the sector that performed the worst in the month of March, was consumer discretionary stocks. And in case you were wondering, the worst stock year to date in the S&P 500 is Tesla. So far in 2024, Tesla has lost 28% of its value. Now, markets have been very strong since the beginning of November last year. And the question is, what will happen in Q2? That's the key question that we're all trying to answer. Now, in one of my previous podcast episodes, I laid out my macro expectations for the year, including my macro expectations for the second quarter. You can go back and take a listen to what I said in that episode. I really haven't changed much of my opinion about those macro expectations. So for the second quarter, most of my opinions still hold good as far as I'm concerned. As of Thursday this week, more than 86% of stocks are trading above their 200-day moving average. This is the highest percentage of stocks trading above their 200-day moving average, the highest since August of 2021. And whenever this happens, whenever more than 80% of stocks are above the 200-day moving average, markets tend to stay bullish for longer. So Q2 is setting up to be a very interesting quarter, with some macro weakness building up, yet markets staying in a bullish mode. Talking about macro, fresh off the press, today Friday while markets were closed, we got an updated PCE inflation report for the month of February. Now, I've mentioned this before. The PCE inflation index is the preferred inflation index preferred by the US Feds. They watch this inflation index very closely as they make interest rate decisions. So the PCE inflation index for the month of February rose 2.5% year over year. Core PCE, which excludes food and energy costs, rose 2.8% year over year. Both of these inflation numbers came well in line with estimates from Wall Street as well as from the Fed. Inflation continues to trend lower, in line with the Fed's expectations, and this is also as reflected in their most recent dot plot. And talking about the US Feds, well, they wrapped up their latest committee meeting on Wednesday, March 20th, while I was away. And as I expected, they held the current interest rate steady at 5.25 to 5.5%. There was no rate cut announced in this meeting. So why is the US Fed and their actions and their words important? Well, the Fed set interest rate monetary policy in the United States. Now, they set short-term interest rates. Longer-term interest rates are more derived from short-term interest rates, and they move up and down based on market forces. So automobile loans, home mortgages, home equity loans, business loans, and even corporate credit. These are examples of debt or loans whose interest rates are more market-driven. They tend to be more long-term interest rate-driven. Rates are important, very, very important for small businesses, medium-sized businesses, and for small-cap stocks. As an investor who invests in small-cap stocks, it's very important for us to understand how long-term and short-term interest rates are moving and how they impact the future prospects, the forward prospects of the companies we own. These rates decide how much interest we earn on fixed deposits, on CDs, on money market funds, and other short-term investment vehicles. In fact, what we also need to understand is the US Fed, or the US FOMC, is the leading global central bank around the world. And in fact, other central banks follow the lead of the US Federal Reserve. If the US holds interest rates, other central banks tend to hold interest rates. If the US raises or cuts interest rates, the others tend to follow as well. So in many ways, Chair Powell, as the head of the US Federal Reserve, is kind of acting as the de facto chair of the global Federal Reserve Bank system. And by the way, there are exceptions to this kind of general rule in the markets. And one of the biggest exceptions that we learned about recently was the Japan Central Bank. So while most other global central banks have been dealing with inflation, have been raising their interest rates, and are now waiting to cut interest rates as inflation is trending lower, Japan actually went the other way. They just raised interest rates in their country. In fact, they ended what is called negative interest rates, or NIRP. Their economy is a completely different case study. It's a rabbit hole that we will avoid for today's podcast. But suffice to say, what the US Federal Reserve Bank does is very important not only in the US, but also around the world. So what did the Feds decide at this March meeting? Well, as I mentioned, they held the current federal rate steady at 5.25 to 5.5%. Interest rates, these short-term interest rates, have been at their highest level since the year 2000. This is the fifth consecutive meeting with no increase or no change in interest rates in the US. Previously, the central bank, or the US Feds, had raised this benchmark borrowing rate 11 times in a row, and rates are now well above the long-term average of 4.4%. The Feds also decided that they would continue the quantitative tightening program that is in place. What they're doing as part of this program is that they are selling bonds that are on the Fed's balance sheet. They're reducing the value or the assets on the Fed's balance sheet at a pace of $95 billion per month. So they are selling treasuries that they own. They're selling mortgage-backed securities or mortgage-backed bonds that they own. By selling these bonds in the open market, they're actually trying to take liquidity out of the financial markets and control financial conditions within the markets. Now, the FOMC's challenge is fourfold. Now, they talk about their dual mandate, which is healthy unemployment and low inflation. But I've always believed that the FOMC has four goals. One is to maintain healthy employment. They are interested in making sure that unemployment stays below 5%. Second, they want to keep inflation in check. They've publicly mentioned that their target inflation rate is 2%. However, I think 3 to 4% is more realistic from a long-term standpoint. The third thing that the Feds do, they are interested in supporting economic growth. They want to make sure that the U.S. economy grows at a GDP growth rate of about 2 to 3% per year. And their fourth goal is to manage messaging and communication to the U.S. financial and the global financial markets. As they make decisions or as they analyze economic conditions, their fourth goal is to make sure that they are clearly communicating to the markets about what they know, what they anticipate, and how they're going to deal with any future risks that are on the horizon. So what did they report during this March meeting? Well, they published their most up-to-date dot plot forecast. If you remember, the US Fed's dot plot is actually a graph of what they project future GDP growth to be, future unemployment rate to be, future inflation, etc. And they publish this dot plot forecast about 3 to 4 times a year. So the Feds published their latest dot plot forecast after this March meeting. They expect 2024 GDP growth in the US to be over 2%. In 25 and 26, they also expect it to be well within their target range of 2% each. Unemployment, they don't expect unemployment to go above 4% this year. Now that's really interesting. We're already at 3.9% unemployment rate in the US. The Feds are expecting unemployment to stay very close to 4%. They expect inflation to be within the 2.4 to 2.6% range, which is incidentally very close to the inflation numbers we got this morning. In 2025, they expect their PCE inflation index to come down to 2.2%, and then in 2026, it will come down to 2%, which is their inflation target. The Feds also reiterated through the dot plot that they're expecting to make 3 interest rate cuts by the end of this year. And by the end of this year, after those 3 cuts, interest rates will be at about 4.6%. At his press conference, Fed Chair Powell described the current level of interest rates as restrictive and said that it will likely be appropriate to begin dialing back these interest rates at some point this year. So this is their plan. They plan to continue to keep interest rates high, to keep pushing inflation lower. But at some point this year, they are signaling to markets that they are ready to make up to 3 interest rate cuts through the end of 2024. Now, inflation is still trending lower from the highs of July 2022. And despite the progress, inflation is still well above the Fed's target of 2%. In fact, this morning's reading gave us 2.5 and 2.8%. But the slope of the downward trajectory is unmistakable. It has continued to go downwards, and even though it's flattened out a little bit lately, the general trend is still downwards. What I find interesting is that the Feds are signaling that they are ready to cut interest rates well below inflation hitting their 2% target. If you go back to what I said about the dot plot, they expect inflation to be at 2.4% by the end of this year, and 2.2% by the end of 2025, and 2% in 2026. So the Feds are ready to cut interest rates a full 2 years before the PCE index hits their 2% target. The pace at which they continue to cut interest rates, of course, will depend on the pace of the decline in inflation rate going forward, as well as it'll depend on the rise or the rate of rise in the unemployment rate. The Feds promise to be or to continue to be data dependent. They're going to continue to watch the macro data coming in very closely, and they will then decide how quickly or how slowly they want to cut interest rates going forward based on the information that they're getting from the markets. As per the Bank of America, the FOMC has fully embraced the soft landing thesis. They made upward revisions to growth for 2024, 25, and 26. They recognize that there is firmer inflation prevalent in the US today. They also recognize that labor is still very strong. However, the Feds see, according to the Bank of America, the Feds see that inflation is trending lower, even though it continues to remain in place. So this is the Goldilocks soft landing scenario that we have been talking about as far as what the Feds are expecting. And so far, all the data is giving them data to show that we are heading towards this Goldilocks soft landing scenario. Now, a year ago, it felt as though the Feds needed to raise unemployment in the country to get rising costs under control before they were willing to be ready to cut interest rates. But right now, it doesn't feel like they need to push conditions to a point where unemployment rises to get inflation under control. Right now, it feels like they're okay with higher GDP growth, which is coming through. The Feds are okay with even a stronger labor market, as long as inflation continues to trend lower. And this makes them ready and wanting to cut interest rates this year. Chair Powell, in fact, made it very clear that he is happy with things as they are. He's comfortable with this higher growth, and he continues to remain committed to returning inflation to the target over time. So this was a very dovish FOMC meeting. It was a very dovish press conference. Markets liked what they heard, and they took it in their stride and remained positive shortly after the meeting. So what's the takeaway from all of this information? What's the investor actionable takeaway or set of takeaways? Well, the question we have to try to answer is, when will the first rate cut come? I continue to believe that in the May meeting, the FOMC is unlikely to cut interest rates. So I don't expect the first rate cut to come until June, most likely July, in fact. I mean, the Feds want to be sure that inflation is decisively moving towards their 2% target by the end of the year, or in 2025 or in 2026. They want to be completely sure that that is happening before they begin to even put out the first rate cut. June or July is more likely for that first rate cut because, one, if growth slows down in Q2 and Q3 as I expect, then there'll be a slight increase in unemployment around that time frame. Unemployment is right now at 3.9%, and it could be at 4% or even slightly above 4% by Q2, Q3. And those would be the ripe conditions that the Fed wants to see before they execute their first rate cut. Now, after July, the next meeting is in September. So you've got a gap of 2 months during which the Feds can't really do anything with respect to rate cuts, and markets will be dealing with the interest rates that are prevalent at that time. But that 2-month gap allows the Fed to see how the economy will react to the first rate cut that they might execute in July. So it gives them a chance to kind of throw out a trial balloon rate cut in July, take 2 months to see how the economy is dealing with that rate cut, and then at the September meeting, they have an opportunity to make another rate cut. Now, let's say the Feds don't make a rate cut in May, June, or July. Then their first opportunity to cut rates are going to be in September. And that's too close to the upcoming US elections in November. It could look like an election-influenced decision if they put out their first rate cut in September. So in a nutshell, I'm expecting the first rate cut in either June or July, then a break, followed by another rate cut in September, and maybe the third one in December. Now, small cap stocks are most impacted by rate cuts and are still trading in kind of a range since the beginning of the year. They zoomed up in November last year, but as they got into 2024, they've really been kind of range bound as long-term interest rates have stayed stagnant as well. So as that first interest rate cut hits us in the middle of this year, small cap stocks could take that as a bullish sign and they could start rising probably in the May-June timeframe. I'm going to be keeping a close eye on the small cap indexes because I'm interested in a short-term swing trade in that index as we get closer to interest rate cuts in the middle of the year. Now let's shift gears and talk about AI, our favorite topic these days. Well, we recently learned that Apple is in talks with Google to potentially use Google's Gemini AI engine on the iPhone. Apple has been very quiet about their AI plans and progress. And in fact, in the last earnings report, they promise several important AI-related updates at the upcoming June Worldwide Developer Conference. Now, if you haven't seen their WWDC conference announcement, I would encourage you to go take a look at it. They've got several Easter eggs in that recently released announcement. I'm not going to spoil it for you, but I'll give you a hint that those Easter eggs are all about, well, you guessed it, AI. So according to Bloomberg, Apple and Google are actively discussing a deal that would allow Apple to license Gemini, which is Google's set of AI models, that will allow Apple to license Gemini for use on the iPhone, on the iPad, on other Apple devices. Now, the aim is to use this technology to power some of the new features that are expected to be added to their iOS software later this year. Apple's coming out with a major, massive, one of their biggest software updates in a few years. This iOS 18 is due to come out usually it's released in September of the year. And the features that we're going to see in this iOS 18 software, those features are expected to be announced at the June conference. Now, Apple reportedly also held similar discussions with OpenAI and explored the possibility of using their model. But for whatever reason, it seems like they are now in more serious talks with Google about a similar partnership. If Apple and Google reach some sort of agreement on AI models, this would significantly expand their existing partnership. Now, for several years, Google has been paying Apple billions of dollars annually to serve as the default search engine in the Safari browser on the iPhone and on their other devices. Now, the details of the AI-related discussions have not been confirmed yet, but if this comes to fruition, this would give Google and Gemini access to billions of potentially new users. Today, as we know, Apple has over 2 billion devices in use around the world, and Google's Android operating system is in use by over almost 3 billion devices around the world as well. So if they do team up together, you're talking about Google's Gemini getting access to almost 5 billion or over 5 billion devices globally. Now, if this happens, it could also lead to further antitrust scrutiny of both companies. Both Google and Apple are currently being sued by a variety of US and European Union authorities for a variety of antitrust reasons, for using their dominance to control markets and pricing on the devices, in the app stores, etc., etc. Now, it was also reported that Apple is in talks with Baidu in China to use Baidu's AI engine on their China version of the iPhone and Apple devices that they sell there. It's rumored that Apple wants to partner with these locally dominant AI leaders in the regions or in the countries that they serve because they want to customize the AI experience for their local users, in this case, for example, in China. By partnering with Baidu on a Chinese AI engine, by using that in their iPhone there, they believe, or it's believed, that Apple wants to highly customize that AI experience for their China users. So the key question for investors is, will Apple be a laggard or a leader in the AI race? So far, they've been very quiet about their AI ambitions. They've been very quiet about their AI plans and progress. Apple is often very patient and deliberate in introducing new technology to the market. But when it does so, when it does introduce something new in the market, it focuses on doing this really, really well. We've seen these play out in the past. When it came out, Apple took its time to bring out its first big screen phone. A lot of other phone manufacturers like Google and Samsung were putting out larger and larger 7-inch, 8-inch, 9-inch phones, but Apple took its while to get up to that 6 and 7-inch big screen phone. They took their time to put out their version of the Apple Watch, as well as most recently, they took their time to come out with their first version of the Visual Pro headset, even though visual or AV or AR, VR headsets have been in the market for years. Another great example, Apple does not have a foldable phone today. whereas other phone manufacturers, most recently Samsung, has a very successful foldable phone that they sell in the market. So it's rumored that Apple has continued to make progress on AI internally. They've continued to test out various AI related features and services that they plan to add to their devices. They've been conducting their own trials on their language model called Ajax, which is based on Gen AI technology. They've been testing Ajax since the beginning of this year. They've also adopted some AI related technologies that they inherited from the Apple Car project that was recently shut down. And some of their employees have been experimenting or testing out a chatbot internally called Apple GPT as well. But according to industry insiders, Apple's technology is currently less advanced than its competitors. So collaboration between Apple and some of these other AI leaders might make sense. I mean, it certainly might make sense in some international markets if they want to customize the user's AI experience on their device. As I mentioned, if this deal between Apple and Google goes forward, suddenly now Google has access to over 5 billion devices across the world. It already has over a 90% share in the search engine world. And putting their AI engine on 5 billion devices really takes the cake in favor of Google. Today, Google pays Apple over $20 billion per year for that default search engine deal in order to be the default search engine on the iPhone and other Apple devices. We're not sure how much Apple now will have to pay Google in return for the use of their AI engine. So much more to come on this story. It'll be interesting to see what Apple announces during their developer conference in June. I will be tuning in, as well as I'm sure investors like you will be tuning in to really listen to what Apple has up their sleeve in the AI space. Now let's change gears again. Let's talk about one of our favorite food items, chocolate. Well, chocolate is getting more expensive by the day, and it has been getting expensive all this year, in fact. This is because cocoa prices have surged to a staggering $10,000 per metric ton in the last week of March, just this past week. Cocoa prices have been on an unprecedented 240% price increase from last year so far, just in Q1 of this year. In fact, on Monday itself, cocoa futures prices escalated by another $700 per metric ton, the largest one-day increase in that commodity's price, an all-time new record. Well, this surge in cocoa's prices, this market performance of cocoa's prices as a commodity are on par with that of Nvidia's stock price performance for the year and ahead of Bitcoin's performance for the year. The question on everybody's mind is, what's causing this astronomical rise in cocoa prices? According to a recent Reuters report, a series of unfortunate events in West Africa, particularly in Ghana and the Ivory Coast. Today, these two countries dominate the growth and supply of cocoa around the world. Ghana and Ivory Coast today produce over 60% of the global cocoa supply. And there have been a series of unfortunate events in West Africa, specifically in these two countries. The biggest reason is that there's been a rampant spread of diseases affecting cocoa plants in this region. El Nino, the El Nino weather effect, the El Nino brought heavy rains to that region in December, and those rains damaged crops and facilitated the spread of the dreaded black pod disease that affects these plants. So cocoa plant production has been much lower than usual this year. This has reduced the supply of cocoa that gets harvested from these plants, and therefore it has kind of changed the supply-demand equation around the world. Added to that, there's been certainly mismanagement within the sector and illegal gold mining, which tends to kind of deforest those regions and take away farmland where these cocoa plants are grown. In the US, consumers have started feeling the pinch. Nelson IQ recently published data that showed that Easter-related chocolate prices have gone up more than 10% as compared to last year. So talking about prices, here are some fun statistics. If you own a ton of cocoa today, you can exchange that for about 10 shares of Nvidia, or 55 shares of Tesla, or 4.4 ounces of gold, or 117 barrels of light crude WTI oil, or you can exchange that for 1.1 tons of copper. Yeah, cocoa is more expensive than copper today, so you can get more copper by weightage in return for that 1 ton of cocoa if you make that barter exchange. Now, the price increase in cocoa has been further intensified due to the increased hedge fund activity in this commodity space. Seeing the initial rise of cocoa prices, as well as weather reports from that region, as well as reports about the health of crops, speculative traders have recently been moving in, and they've built up a substantial $8.7 billion futures position in cocoa contracts. This indicates their belief that prices in cocoa will continue to rise from here on. This is the largest ever speculative hedge fund position in cocoa futures in terms of dollars. And this is based on data that we got from the Commodity Futures Trading Commission. Cocoa has been the single biggest contributor to profits at hedge funds like these that trade in commodities, according to Societe Generale. So it's tough for companies that are involved in making cocoa or chocolate-related products to operate as usual this year. The major cocoa processors, these cocoa processors transform cocoa beans into cocoa butter, and cocoa butter is then sold to the chocolate factories that make chocolate out of it or other chocolate products. So it's really tough for companies like these cocoa processors or even the chocolate producers to secure an adequate supply of cocoa this year to meet the demand that they're getting from the markets. These hedge funds and speculative traders have really cornered the cocoa commodities market to the point where supply and demand is completely out of whack. And so what will happen is that prices will stay elevated. They might even continue to go up, and prices will be passed on to consumers, and people like you and I will be paying more in the grocery store to satisfy our fetish for chocolate. So what's coming up in the markets next week? Well, there are 3 very, very important macro updates that are coming next week. On April 1st, Monday, we get the ISM manufacturing report for the month of March. On April 3rd, Wednesday, we get the ISM services report for the month of March. These 2 macro reports, the ISM manufacturing and the ISM services report, are 2 leading macro indicators that I closely follow as I'm trying to understand where the US economy is heading in the future. If you remember, the last reading that we got for the month of February was not as rosy as we thought it would be. In fact, February broke the upward trend that we had seen for the previous 2 to 3 months. So I'll be interested to see what happens in the month of March. And then on April 5th, Friday, we get the US jobs report for the month of March. We will get an update on the US employment rate, the US unemployment rate, jobs created, etc., etc. So these 3 reports, the ISM reports as well as the jobs report for the month of March, are going to hit us next week, and we will tune in and I will bring you updates on them. So that's all I have for this episode of the Market Whispers podcast. Drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest. For life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.